opportunity. I would love to have this interaction very interactive, because if nobody asks the question, then we will also not learn from our end. So basically what we will be covering is NBFC, what are the issues on TDS, income tax and tax audit. We have tried to put a practical approach while discussing this matter, because otherwise if we discuss theory, people would start thinking, okay, we could have read the act itself, and why there was a need for attending a presentation. So basically we have taken a practical example. If at all people have a question, they are free to ask the question and we have no issues. So basically NBFC, so the term NBFC has not been defined in the Income Tax Act as well as the Companies Act 2013. And if something has not been discussed, not been defined in the Income Tax or Companies Act 13, then there is a decision of Supreme Court in case of Sahara, which says that you have to actually go to the other acts to understand the meaning of this. So the term NBFC has been defined in the RBI Act 1934 under section 45(1)(f). And there was already two speakers who had spoken on the RBI circular, the master direction. They would have spoken on NPA, income reversal, then they would have spoken on the SB regulation. So basically all this definition which we would do from the income tax perspective has to be in line with the RBI Act itself. So basically what is the definition of NBS per RBI Act? So it says it has to be a financial institution which is a company. So any financial institution which is a company would always be a NBFC. But in respect of non-banking institution, if it has a principal business of receiving of deposit or lending in any manner, then it would be NBFC. And there is a miscellaneous clause which says that such other non-banking institution which the RBI or central government may specify in this behalf. So all this would be NBFC. I would not be discussing much more from the RBI perspective, because that would have already been taken care by the earlier speaker. But NBFC uses the word non-banking institution. So which are these non-banking institutions which would be covered under the definition of NBFC? So basically any company doing the business of financing, then it is doing an acquisition of shares, stock, bond, debenture or securities, then letting or delivering of any goods under the hire purchase agreement, carrying on any insurance business, or managing, conducting or supervising as a foreman agent. So basically this is a definition of NBFC. Now all this definition is already part of RBI Act, which would be covered in the earlier session. I would specifically focus on the income tax point of view and TDS perspective. So basically there are two sections which deals with the TDS on a payment of interest. One is section 193 and another is section 194A. Section 193 of the Act deals with the TDS on a payment of interest on securities, whereas 194A deals with the payment of TDS on payment of interest other than on interest on securities. So basically, has the word security which has been defined in the in section 193 or 194A? Answer is no. Both the terms has not been defined in section 193 or 194A of the Income Tax Act. Basically, for that you need to go to the definition which has been used in other sections. So that is section 47 of the Income Tax Act, which basically which defines the term security. So that term also refers to the Security Regulation Act, 2H of the Security Regulation Act, which defines the term security. So there the word security has been defined to mean bonds, security, shares, equity shares, everything has been termed as a security. So if it falls under the definition of security as per 2H of that particular act, then any interest paid thereon would be subject to TDS under section 193. Whereas if it is a fixed deposit which has been kept with the bank, if it is a corporate deposit placed with the company, which doesn't fall under the definition of securities as per the particular act, then any payment of interest thereon would be like falling under 194A of the Act. Now there is a different exemption limits. There is a different sections applicability which is in 193 vis-a-vis 194A, and therefore this distinction of what is a security is very, very important. So basically section 193 deals with the interest on securities. Securities would mean bonds, debentures, all the person. Like there is an exception in under section 194A that it would not apply, the deductor need not be a individual or an HUF who are not required who are not liable for the tax audit. So then they are not required to deduct TDS under 194A. Whereas under section 193, basically all the payer has to deduct TDS under section 193. The rate is same, 10%. If at all you have a PAN, if you don't have PAN number, 206AA would apply and the rate will be 20%. The threshold for 193 is 10,000 rupees, whereas there are three different thresholds for 194A. One is 10,000 is a general threshold, 50,000 if the payment of interest is made by the bank, and that's a 1 lakh for the senior citizen. All this limit has been revised with effect from 1st April 2025. Now, basically, before we jump to what are the like exception, TDS exemption which has been allowed by this section 193 or 194A, I would give you a practical example. See what has happened. Basically, you would have come across many NBFC who had issued a debenture and bonds where the payment of interest is made on two coupon dates. One would be 30th of June and second would be 31st of December. Now, in this scenario, basically, these are a listed bonds and debenture which are traded on the recognized stock exchange, and therefore it is possible for you to transfer it if at all you want to sell it on the stock exchange. Now, issue here is that if the payment of interest is on 30th of June and 31st of December, and then comes a 31st March, where the interest expenditure has to be provided in the books of accounts. Mere on the basis of provision made in the books of accounts, am I required to deduct TDS? Because what can possibly happen is, as on 31st March, one X would be a holder of that particular bond and debenture, whereas if on the payment date which is subsequent to the date of provision, he might have sold the thing. So issue which had arisen was whether section 193 would be applicable requiring deduction of TDS when there is a possibility that basically the shareholder, the bondholder or debenture holder would have changed, and therefore you would deduct TDS in one name, whereas the income would be offered by somebody else. So there is a decision of Mumbai Tribunal in case of Industrial Development Bank of India, which is reported somewhere in 107 ITD, which has clearly laid down that section 193 would not be applicable in a case where you do not know who will be the receiver of income, and therefore even though you make a provision in the books of accounts, which ideally as per the language of section 193 would trigger the TDS provision, the court has clearly laid down that TDS provision would not be applicable. The logic which was applied by this Mumbai tribunal was basically the TDS is only a means of collecting money from the income holder beforehand. So if you do not know who will be the final receiver of the income, TDS provision would not be applicable, and therefore they said that there is no need to deduct TDS under section 193 when you make the year end provision as on 31st of March. So then they said there is no need to deduct TDS. And once the court has said that there is no need to deduct TDS, then there is no question of then there is no question of collecting it from your penalty being levied. Now, another corresponding issue which would come here for is basically earlier the disallowed section that 30% of payment were disallowed because you have not deducted TDS was not available when all this case law had came up. Now issue is when now there is a section 41A which is applicable to payment on which TDS has not been deducted. Would this get trigger or not? So here the logic behind is basically if I read the language of section 40A1A, it says that 30% of any sum payable to a resident on which tax is deductible at source under chapter 17B is and such tax has been not been deducted or after deduction has not been deposited. Now where the court has very clearly laid down that section 193 would not be applicable because you do not know who is the receiver of income, and therefore even the corresponding question of disallow under section 40A1A would not arise, and therefore because you have not deducted TDS under 193, there will be no corresponding disallowance of 30% of interest while computing the total income of the payer. So that is something which needs to be kept in mind, because if something is not, there is no requirement of tax under chapter 17B and it has not been deducted, then the disallowance under 41A would not arise. Another so basically 193 would not be applicable in that particular case. Now basically before jumping to what are the TDS exemption under 193, 194A thing, basically I would just would love to highlight that before jumping to see, we had one client which was an NBFC. They came to us that basically now we are required to deduct TDS under section 193. So the background of that was basically earlier before by Finance Act 2013, they had removed an exemption from TDS which was earlier granted to securities which were held in a demat form and which were recognized on the recognized stock exchange. So then if at all you are holding of a bond or debenture which are listed securities and which can be traded on the stock exchange, then there was no requirement of deducting TDS. Now after the removal of that particular exemption, the NBFC came to us that now we are required to deduct TDS, you give us an opinion. We said that we are happy to give you opinion. We quoted a fee. They said we are fine with the fee. Then we started the exercise. When they really came to us for the opinion, we saw that there were 1,000+ clients who had made investment in bond and debenture. We said that if we start examining for 1,000 clients, then it will be a very, very difficult job, because then I need to see the documentation of each of the 1,000 clients before I say whether the TDS would be applied or not. So in that particular scenario, what we saw was that basically TDS exemption under section 193 has been divided into certain particular parts. So then what were the TDS exemptions? So there is a TDS exemption which is on interest on certain specified government security, any interest payable on any security of the central government or a state government, any interest payable to LIC, GIC or other insurer, or any interest payable to a business trust. And okay, so basically these were the exemption which were available. Now, are these the only exemption which will be available to a bond holder or a debenture holder of the NBFC? Answer was no. There are three different type of sections, CBDT circulars, which grants the TDS exemption. So one is a specific section 193 or 194A3, depending upon the payment of interest on security or other interest on security. One is section 196 and third is CBDT circular number 18 of 2017. So if your client falls under any of the three category, then it would enjoy the TDS exemption. So when we started reviewing the 1,000 account, we went through section, what are the specific exemption which are available under 193, what are specific exemption available under 194A, then we moved to section 196, and then we saw the CBDT circular 18 of 2017. Now people would see, earlier there were various CBDT circular which would grant TDS exemption if your income was exempt under section 10 and you are not required to file tax return. But after this CBDT circular 18 of 2017 has removed all earlier exemption, and now exemption are limited only to the entity which has been mentioned in the CBDT circular and not otherwise. So now at least there is one place which you need to check for to see whether there is a specific exemption available or not. So while doing that exercise for 1000 client, we went through section 193. We went through section 194A, which would not be available because they were primarily came to us only to see that whether there is an TDS under 193 or not, because it was a listed bonds and debenture. But we went to like section 196. Now section 196 is a special category of section which applies to all income all across. In a sense, any payment of income to the government, you need not deduct TDS. So if it's a payment to a government, central government or a state government, then there is no requirement to deduct TDS. Then any payment of income made to Reserve Bank of India, then there is no requirement to deduct TDS. Basically, any corporation established or by or under the Central Act, whose income is exempt from income tax, is not, it will fall under 196. Then mutual fund. So while it is very simple to anticipate that any payment to government, central or state government, there is no requirement to deduct TDS. Reserve Bank of India is also very, very clear. What could possibly fall under the corporation established by or under the Central Act, whose income is not subject to income tax? So we went through the list of such payment. So we could come across that there is only a SEBI which falls under this category. So if you are making any payment to a SEBI of any income, then you are not required to deduct TDS. And basically income of SEBI is not taxable. There is no exemption available in the Income Tax Act, but there is a section 12 of the SEBI Act which says that it has been granted an exemption from payment of income tax, and therefore that is SEBI would fall under this particular category. And any payment of mutual fund, then there is no requirement of deducting TDS. So basically we saw section 193, we saw section 196, and then we went to the CBDT circular of 2018. Now basically CBDT circular 18 of 2017 grants TDS exemption to certain specified fund or authorities or board or bodies referred to in section 10 of the Income Tax Act, whose income is unconditionally exempt under that section, or who are also statutorily not required to file their tax return. So basically they have listed down a specific sections to which this CBDT circular 18 would apply, and if at all the entity to whom you are making payment doesn't fall under any of this category, then there will be a TDS deduction for sure. So when we started that exercise for 1000 plus clients, they came to us with a categorization of basically all 1000 into a trust, then nationalized bank, then they came with companies, then they came with certain statutory bodies. Then once we had gone through section 193, 196 and the CBDT circular, we could suggest to them that it would not be possible for us to review each and every 1000 client, but if you give a categorization of all the 1000 client into this particular fashion, then it will be easy for us to apply the law. So when they came to us, there were certain payment which were to be made to like LIC, GIC, UTI, banking company. All this will clearly, so basically if the payment is to be made to LIC, GIC, then there was no requirement to deduct TDS. Then if the payment is made to other insurer also, there is no requirement to deduct TDS. All this thing we analyzed, and then we finally gave an opinion if there is a payment to be made to this particular thing, no TDS, otherwise there will be a TDS deduction of 10% on all the balancing. Now, if you see this particular CBDT circular, it gives a exemption to the statutory provident, superannuation and gratuity fund, which are claiming exemption under section 1025 of the Income Tax Act. So for you to before you grant the exemption under section 1025, you have to actually call for the documents from them, whether they have the approval of the commissioner or chief commissioner before you grant the exemption. But to review all the document for all 1,000 client was likely not possible. But if at all they come to us that this is a 25 payer of the receiver of income to which section 1025 applies, and we have checked that they have the approval of the commissioner, then for us to give an opinion, then there is no TDS requirement, is very, very clear from the reading of this CBDT circular itself. So another payment was like payment to this local authority. Now section 1020 applies to this municipal corporation, panchayat, everything. So if at all they have a letter from this that we, basically we are a municipal corporation to which section 1020 would apply, it was very easy for somebody to say that there is a complete TDS exemption. And we have to actually go through each and every section, each and every categorization before we say completely that there is whether there is a TDS exemption or not. So these are the three sections which you have to actually go through before you give an opinion to somebody whether like there is a TDS exemption or not. Now this what we discussed was about the listed bonds and debenture. There is a section which also section 194 says that TDS is required to be deducted on payment of interest on interest other than securities. So basically what is that is why it is very relevant to understand the meaning of security, which is as per the 2H of the Security Regulation Act. But if you see this minutely, there are some difference in 193 and 194A. When we were checking it, if we see 193, it gives a TDS exemption to other insurer, whereas if we see 194A, it gives a TDS exemption to a company or a cooperative society carrying on the business of the insurance. Now, what is this other insurer in section 193 and what is this company or a cooperative society carrying on the business of insurance in 194A? And therefore, before you apply a law to this particular payment, you have to understand what is the difference. So we try to search for like what is the difference. Both the deals with insurance, one says other insurance and other says like business of insurance. So while we were searching for this answer to this, basically only the company which are registered with the IRDA carrying on the business of insurance are eligible under 194A. So it will be GIC, it will be New India, it will be National Insurance, which are established as a company who has a IRDA license to carrying on the insurance business, who will fall under, who has a TDS exemption under 194A. Whereas if somebody is carrying a business of, there was a concept of facultative something, and that would, even if it is not a company, they would fall under the definition of other insurers and they would be eligible for TDS exemption under section 193. So the reading of the both the section where the words are slightly different would also be relevant while giving an opinion. So basically, if you see the last paragraph of section of this TDS exemption under section 194, that is very interesting. There is a section 194A33F which says that like notified institution notified by the central government would be eligible for TDS exemption under section 194A. Now any corporation established under the central, state or provisional act, companies in which all the shares are held by the government, RBI or corporation owned by the RBI, or any undertaking or body including a society registered under the Societies Registration Act 1860 and which is wholly financed by the government are eligible for this exemption. Now basically we were also doing a similar exercise for a banking company where we were required to examine whether it would be entitled to a TDS exemption under section 194A3, and sometimes you have to actually go to the website of the one particular client to find out whether it is a society registered under the Societies Registration Act and whether it is wholly financed from the government. If the ChatGPT or any website would not give that particular confirmation, then we have to take a letter from the particular that particular society that it is wholly financed by the government before allowing them a complete exemption under section 194A. And therefore it was if that bank has around 10,000 clients, we were required to, as a part of internal audit, to give them a confirmation whether the 194 has been correctly applied or not. This was slightly a difficult task, but we had to we went through each and every client's profile. Wherever it was possible to confirm, we confirmed. Wherever it was not possible to confirm, we got the additional confirmation from the client, and thereby thereafter decide whether 194A would apply or not. So as I said, there are 3 sections including CBT circular, which needs to be very carefully gone through before confirming the fact that whether TDS has been correctly applied or not, and that's need to be read carefully and applied carefully. Now, what are the other sections which are basically applicable to NBFC and which will be relevant for anybody dealing with the HDFC? Now, basically the section which were applicable were 3-4, but we'll start with section 36(1)(7). So section 36(1) says that NBFC can claim a deduction of actual bad debts written off as irrecoverable in the books, and there must be an existing debt arising in the course of a business. The debt should have been included as an income in the current year or a previous year, and the bad debts must be written off in the books of accounts. Merely making a provision would not qualify for 36(1)(7). So basically this is in the same manner which is applicable to any other assessee claiming deduction of a bad debts. Only changes, if at all, if somebody is into the lending business, it would be even able to claim the deduction of the principal portion. So that benefit is available to NBFC if at all is given a lending into the lending business, and it can give benefit of 36(1)(7). Now basically there is another section 36(1)(7)(a), which says like NBFC can claim a deduction for provision for bad debts, doubtful debts created during the year, subject to maximum of 5% of the total income before the deduction, and chapter 6A. So basically earlier only banks were allowed provision for bad debts to be made, but now after 2017 even NBFC can claim the deduction up to 5% of the total income. Now one issue which had came up before the Karnataka High Court was on the NBFC claimed the deduction of 5% as per 36(1)(7)(a), whereas in the books of account it had not created any provision for bad debts. The question is whether this 5% deduction is automatic or it is subject to you making a provision for bad debts in your books of account. Anybody wants to contribute? Correct. So yeah, basically that NBFC had claimed a deduction irrespective of the fact whether the provision was made or not. Karnataka High Court very clearly said that like you have to make a provision in the books of accounts before you claim this 5% deduction, and if at all no provision has been made, you would not be allowed deduction of this 36(1)(7)(a). Now another interesting facts for which even I would not have an answer is, in case similar deduction you also get in the case of a bank. Now in a bank or an NBFC, in certain cases they have opening provision for NPA. They make a provision for NPA during the year based on the fresh loans or fresh advances which has been given. They would reverse or may write off certain provision of the earlier year, which is to be adjusted against this provision for bad and doubtful debts, and then they would have a closing balance. Now one issue which had come up in the case of one particular bank was it had made a during the year it had made a provision of say 10,000 rupees, and there was a reversal as well as write-off of a provision of 11,000 during the year. Then the contention which was made before the assessing officer was that I have made a fresh provision of 10,000 during the year, and that 10,000 itself would be eligible for this 36(1)(7)(a), without seeing the fact that 11th hour was written back or reversed during which was a provision out of the earlier year. So this issue which practically many banks, many NBFCs have been taking up, but then there is no direct case law on this particular subject, but people have been taking advantage. And what I understand that this was examined not directly in respect of some of the assessee, and it was accepted by the assessing officer. So that position it's possible in a sense for a client of a bank or NBFC. If at all you have something such suggestion, you can give it, and subject to the fact that this is not a very clear answer, but it would really benefit your client. Now issue here is whether this section 36(1)(7) and 7A would apply to all the NBFC. So here the term NBFC has been defined in section 36(1)(7) explanation, and it refers to the 45F the RBI Act, and therefore this 36(1)(7) and 36(1)(7A deduction would be available to all the NBFCs. Now coming to others applicable sections to the NBFC, so then there is section 43B. Section 43B, we would have presumed that it would apply to all the NBFC, but once you go to this CBDT notification number SO4193E, it says that it would only apply to a top, upper and middle layer NBFCs as per the RBI guideline, and therefore it would not apply to a base layer NBFCs. Now basically this base layer NBFCs are a small NBFCs, whereas this top, upper and middle, so there is a top layer NBFC, there is nothing at present in this particular list, but upper and middle layer has certain NBFC within that. Now issue which would arise here is that if at all your client is if your client has made a payment of has not made a payment of interest to this base layer NBFC, would you be able to claim deduction under 43B? What will be your response? Since section 43B has been made applicable only to this top, upper and middle layer NBFC, and it is not applicable to a base layer NBFC, even if you have made provision of interest to payable to a base layer NBFC, you would still be able to claim deduction thereof. So basically this is something which you should keep in mind while if you are doing the tax audit of any particular NBFC, or you are doing a tax audit of a client who has made a provision or made a payment of interest to this NBFC. Now another corresponding section which is also very interesting is section 43D. Now what does this section 43D says? It says that in respect of a banks and there are certain other institution, it says that if there is a interest income on NPA, then it will be taxable only on the receipt basis, and the period from which you have accrued interest till the time it become NPA, it has to be reversed in their financials. So basically section 43D applies to long list of entities, which would also include I'll just read out to whom it would apply. It applies to public financial institution, scheduled bank, a cooperative bank other than a primary agricultural credit society, or such classified non-banking financial company as may be notified. So basically this, as I explained to you, this 43D also doesn't apply to a base layer NBFC. It only applies to the top, upper and middle layer NBFCs. So if at all you have a client who falls under a base layer NBFC, even though the RBI says that any provision for NPA has any interest income on NPA has to be reversed during the year, and it will be taxable only in the year of actual receipt. Books of accounts of that base layer NBFC would also be prepared on that basis, but income tax has a very specific section 43D which needs to be complied with, and therefore even though books of accounts or financial of that base layer NBFC doesn't accrue this income, for the income tax purpose you need to take into consideration such income and offer it to tax. Now question would arise under where we would actually give effect to this such type of adjustment. Answer is ICDS. So basically in case of a bank where there is a specific section 43D which says that interest thereon has to be taxed only on the receipt basis, and if it is reversal of previous thing it is allowed as per section 43D. Section 43D, which is a specific section, would override ICDS. Whereas where there is no specific section for NBFC with like base layer, then Act would not prevail, ICDS would prevail, and therefore all this adjustment needs to be taken into ICDS computation, and accordingly it should get reflected in your tax audit report. It would get reflected in your tax return as well as tax computation. So this is a difference where like books of accounts maybe have a different treatment of interest, whereas but income tax return would have a different treatment. In respect of other three category, the books of accounts would reconcile with the books of accounts would reconcile with the provision prevailing in the Act as per section 43D, and therefore there is no requirement to deduct make any adjustment, ICDS adjustment. So basically from where you get this detail of base layer, middle layer, so then there is a RBI direction 2023 which lays down the criteria. I think so that criteria would have been discussed in your earlier topic, so I am not running it once again. But for any such criteria you have to go to RBI. There is no nothing available on the income tax portal to say that whether you are a base layer or whether you are upper or middle layer. You have to go to RBI website, and when I was checking for the financials of some of the NBFC, in the financial itself they had referred to the fact that they are a middle level or they are a upper level NBFC registered with the RBI with the Reserve Bank of India, and that would give you an indication of what provision would actually apply to them or not. So any question? So if I understand your question correctly, there is an NBFC which is held by a person who has made investment in the shares, and you want to know whether the income there any capital gain would be taxable as a business income or a capital gain. Now basically we had an opportunity of running this question with one NBFC client. See, basically there is a CBTT circular, I remember, of 2016, which says that any assessee has an option to treat some of the investment as a stock in trade and some of the investment as a investment in books of accounts. So if you are treated, if your NBFC client is treating some of the investment in equity shares as a stock in trade, then any capital gain earned thereon would be taxable as a business income. But if you have chosen the other option of treating it as a investment capital assets, then any income thereon would be chargeable as a capital gain only. If you are taking it as a business income stock in trade, I think so you need to value it on the first day of every year, and whatever is the deviation vis-a-vis last day of the year, that will be treated as business income without even selling that particular security. So that's if that is a fact, it will be treated as a business income. If you have already treated it in your balance sheet as a capital asset, as an investment, it would be subject to only tax as a capital gain on the sale of security and not otherwise. No, basically the definition of interest is as per section 228A, which says like if at all you are receiving interest and along with the service fee, then it will fall under the definition of interest, and therefore it will be eligible for exemption. Well, like any company paying to the bank would not be required to deduct TDS. But then there is no similar exemption to NBFC. So if there is a payment which is being made to NBFC of interest income, it will be subject to TDS, and therefore your both the charges which you said would also be subject to TDS. And like if I am making a payment to NBFC, I will be required to deduct TDS under 194A, because it's not interest on securities, it is interest on other than interest on securities. There is no payment of interest, what you say. But then basically what will be the character, what will be the nature of services which has been rendered for which you are making the payment? If it is fees for technical service, it is a contract, then that particular section might apply. And to what I believe is at least 194C, which refers to the contract, would always be applicable in such type of an agreement. So basically his question is that the books of accounts of a base layer NBFC is not matching with the income tax return. It is quite possible you would have not accounted for that particular interest in the books of base layer NBFC, but because of an ICDS adjustment, you have offered it for tax in the income tax return. Now that particular amount is not recoverable, and therefore where the question raises whether you will get a deduction of that particular amount which is unrecoverable, because the particular fact of this transaction would be that you would have not written off in your books of account because it was never appearing in your books of accounts. But if I read section 3617, it has a proviso which says like provided further that where the amount of bad debts or part thereof has been taken into account in computing the income of the assessee of the previous year, in which the amount of such bad or part thereof of the previous year in which the amount of such debt or part thereof becomes irrecoverable, or for an earlier previous year on the basis of ICDS notified under section 145(2), without recording the same in the books of accounts, that will be allowed to as a deduction. So they specifically after this ICDS, they have inserted proviso to section 3617 with effect from 2016. I think so that was the date from which ICDS was notified. It says that even if you have not accounted for in your books of accounts, but it is bad debts, it has been offered to tax in any earlier or current year, you will be able to claim deduction thereof even without writing. Of course. See, if income is not recoverable, then only you will be able to get the deduction of bad debts. So, precondition is that it is not recoverable and you write it off in your books of accounts, you will get the deduction. Uh, no specific reason I know for sure, but basically these are some this base layer NBFCs are all general category who they are not very highly regulated by RBI, and that may be a reason, because I went through the list of upper layer and middle layer, and they were very well known NBFCs, but NBFC which doesn't fall under that so-called good name, they were all in resident, and it was very difficult for income tax or RBI to regulate them. That may be one of the reasons. What I understand basically, you are an NBFC, some amount was recoverable from them. Instead of you getting the money from the lender, you have received a property from property them. And basically, your question is whether any sale of such property will be taxable as your business income, or it will be capital gain. I had not faced this issue in particular any particular NBFC, but in case of one of the bank, they had this particular issue. So when in certain loan amount where they possesses the property instead of the loan amount, any gain or loss on this particular property sold would actually belong to the borrower and not to the bank. And in that case, basically, if there is a capital gain tax which is payable, it would go on in the hands of a borrower, not in the case of a bank. But in certain cases, they just possesses they take possession of that particular assets, which they include in their books of accounts. Once that capital assets has been recorded as an investment out of this repossessed loan, that it will be taxable as a capital gain in their hands. It would be very difficult to take a position that this would be they are into the business of repossessing assets on the bad loans, and to treat it as a business loan would be very, very difficult for them.
For the NBFC, the incomes earned on investments will be considered or not?
So for an NBFC, basically any income on the investment would be their business income, and therefore it has to be included while determining the turnover limit. It is, if I think so, the guidance note which has been issued by institute gives that if at all somebody has as a business entity receives some interest, then it has to be excluded. But for an NBFC, everything would be income, so it would be included. And just to further answer your question, basically I have seen an NBFC whose total income were so it was an LLP. Entire business income was actually getting out of the business income, and it was getting offered under the head capital gains and income from other sources. So any interest income, dividend income, it would get taxed as an income from other sources, whereas any like sale of shares will get taxed under that capital gain. But turnover the business was like considered as a full amount which was credited to profit and loss account, because that was their main business. And since it was an LLP, if the capital contribution from the partner exceeded certain amount, then also it was liable for audit under the LLP Act and under as well as under the Income Tax Act. So basically, if I understand your question correctly, there is an NBFC who has taken over the capital assets of one particular company who was the borrower company, and it has been recorded in their books of accounts. Now, if it is going to sell that particular asset, so so I think so for a bank there is some act which is called as Sarfasi Act or something, where you don't become the owner. Everything is on account of borrower, and therefore there is no question of TDS compliance to be made by the bank per se. No, if I am taking away that property and I am because once I take that property, I would I would show that this was an amount of borrowing which was given to X. I would replace it by saying that this is what I have received as instead of cash I have received as a property. So that I would record in my books of account. Any sale of assets, once it is recorded in my books of account as an owner, I have to comply with all the TDS compliances, including deduction of TDS. Yeah, I think so. We'll take offline and we'll start with the GST. Thank you.
Good afternoon, everyone. Now, Bhavin has taken up the income tax implications or issues in NBFC. We are moving on to the GST issues which are prevailing in NBFC. Now, like many other sectors, even NBFC are also facing a lot of GST compliance and interpretational issues. As we all know, NBFC are operating under dual regulatory framework. One is RBI, where they are following the guidelines for the purpose of complying with the business this thing, and GST for indirect tax compliances. Now, this often creates challenges when the RBI directions are conflicting with the GST provisions and vice versa. If we go to the definition of NBFC, it is more or less, it is almost similar to or same as RBI Act, which has been covered in your previous presentation. So broadly, it says there are three categories of NBFC. One is the financial institution, which is a company. The NBFC, which is accepting the deposits. And third one, which is notified by RBI with the approval of central government. I won't get into details of NBFC because I think it's already been covered previously and even by Bhavin. Now, before deciding or discussing on the issues which are prevailing in NBFC and to decide whether GST is applicable or not on a particular transaction, it is really important that we understand or we just go through the definition of goods and services which are given under the GST Act. Now, so we'll just see the important exclusions or inclusions which are given under the GST Act. So if we see the definition of goods, it says it means every kind of movable property other than money and securities. These are important when we are discussing the issues in the later slides. So the definition of goods specifically excludes money and securities, but it includes actionable claim. Now the definition of actionable claim and its implications in NBFC we'll be discussing in the later slide. The definition of services under GST, it says anything other than goods, money and securities. But it includes any other services which are provided relating to this. But it says it should be other than goods, money and securities. The term securities, again, it takes back to Securities Contract Regulation Act. So any shares, bonds, debentures will be considered as securities under GST, and it won't be treated as goods or services under GST. Now the first issue which we are discussing is relating, or the main component or earnings of the NBFC is processing charges, interest on loans and advances, invoice or check discounting. Now whether GST is applicable on this revenue and what are the issues which are going on relating to this revenue. Now processing fee is what? It's nothing but a consideration which generally is relating to the activity which is done by NBFC at the origination of the loan and documentation other activities. So mainly processing fees is charged which is relating to credit appraisal and risk assessment, documentation preparation and verification, legal compliance and regulatory clearances, loan structuring, negotiating the terms with the borrower, disbursement, coordination and monitoring. Therefore, processing charges amounts to service and GST is applicable on that, and all the NBFCs are paying GST on processing charges. Now, if we go back to the interest income, Now, interest has been exempted wide entry 27 of notification number 12, 2017, pertaining to central tax rates. It says that services by way of extending deposits, loans, or advances, insofar the consideration is represented by way of interest or discount, it will be exempted from GST. Now, interest involved in credit card charges is excluded from the definition of interest. Now, interest which is earned by NBFC on all credit facilities is exempted by way of this notification. Interest is also defined in the notification, which clarifies that interest means interest which is payable in respect of money borrowed or debt, other than any charges which are collected relating to such debts. Now, when we come to discounting, CBIC, via its FAQs which were released on banking and financial sector in the initial rollout of GST, they had clarified that discounting of invoices is nothing but a manner extending a credit facility or a loan. But if you're charging any service fee or any processing charges even for invoice discounting, that would be subject to GST. Now, the issue involved in this kind of revenue is, if you all have heard, the SCNs which have been issued to NBFCs who have a different business model, where they have been collecting the interest upfront, where they have computed the interest, and instead of recovering the interest over a period of time, they have collected the interest upfront. Now, the position which is taken by the department is that this is not an interest, it's a processing fee which you have collected right now, and it is not time bound. So therefore, it is a service fee, not an interest. Now, if we analyze or we see the loan documentation, it is contradicting the substance and the commercial or the understanding between the borrower and the lender. So this is the issue which is prevailing. Ideally, it should be considered as interest, even though it is collected upfront. Obviously, NBFC have to substantiate that it is an interest based on the loan agreements which have been entered, the interest amortization logic, and to substantiate that it's an interest, not a service fee. Now, second issue which is there is on penal interest or penal charges. So whenever a borrower defaults or delays the EMI loan installment or doesn't comply with any material loan terms, NBFC usually charge penal interest or penal charges. Now, whether we can say that it is not subject to GST, it is kind of interest only. Various circulars have been issued in this regard. If we go to circular 102/21/2019, it says value of supply shall include interest, late fee or penalty for delayed payment of consideration for any supply. So if we see section 15 of the CGST Act, there's a specific clause which says that any interest, late fee or penalty, if any supplier is charging, it will form part of the main value of supply. So from section 15 itself, it says whatever additional you are collecting for delayed in payment, it will form part of your main supply, which is your interest income. And the same is supported by the circular 102. If we go to circular 178/10/2022, it also clarifies again that any interest, late fee or penalty which is charged for delay in payment of loan installment is exempt because it is ancillary to your main exempted supply. Now, there's one RBI instructions dated 18th August 2023, which has directed all the regulated entities to levy penal charges instead of penal interest. Okay. Now, there, obviously, earlier the NBFCs were calling it as penal interest to ensure that GST department doesn't constitute as a charges and levy GST, but pursuant to RBI direction, NBFC have to term it as penal charges. Now, whether merely I'm changing the terminology will make it as a charges and will be subject to GST. Now, again, government came up with this clarification by circular 245 saying merely changing a nomenclature doesn't make it a taxable supply. It will still be classified as a principal supply. So even though it's a penal interest is called as penal charges, it won't be subject to GST. Now, again, if you see, there's one more RBI FAQs which have been issued in Jan 2024, which says that these penal charges should be accounted in books as other income and not interest income. Now, whilst the GST department has issued a circular saying that this is not taxable, if this circular would not have been issued, what we discussed earlier, that the conflict between the RBI direction and the GST raises the interpretational issue in the industry. So if somebody, the NBFC accounts this as other income and not interest income, it is bound that the department will take a position. It's a charges, it's not an interest income because yourself has not accounted it as your interest income. But thankfully, the government has clarified it, so it should not be a problem. And initially, when the rollout was being done, some NBFC had started paying, but they stopped because of this circular also. Now again, check dishonor charges. Since service tax regime, I think a lot of us have been grappling on any penalty which the supplier charges, whether it's an agreeing to tolerate an act and therefore subject to GST. Similarly, since GST was introduced, the same declared services was introduced in GST also, and therefore many NBFCs and banks have been charging GST on check dishonor charges. But Circular 178 2022 clarified that it's a breach or non-performance of a contract by one party to another which results in loss and damages to the other party. It is not towards any services by the supplier to a recipient. So if you read the specific clarification which has been given in 178, which has been highlighted in this slide, it says the fine or a penalty that a supplier or banker imposes for dishonor of a check is a penalty imposed not for tolerating an act, but penalizing and thereby deterring and discouraging such an act or a situation. A bank or an NBFC doesn't want that their check should get bounced and they should earn this revenue. Their intent is that the check should get cleared. So it is not a service which the NBFC or bank is providing. It is a penalty which they are charging to ensure that the borrower ensures that the checks are cleared. So obviously GST is not applicable on this, and post this circular, I think most of the banks and NBFC have stopped paying GST on these charges.
Supplier of goods charges similar charges for dishonor.
Ideally, that should not be subject to. Because it's the same logic, because nobody wants that their check should get dishonored and to earn that charges.
But because their main service is chargeable, should it not be chargeable?
No, but I'm saying it's for a breach of non-performance or even, and you have to pay my money. If you're not paying my money, this means you are breaching my terms, because you had agreed that you will make the payment once I supply the goods or services.
So I can depend on the same service?
Yes, you can depend on this. The next issue is relating to foreclosure or prepayment charges. So most often it happens that the borrower decides that they want to close their loan prematurely, maybe in part or in full. So I understand that because of RBI circulars, in some kind of loan facilities, you cannot charge foreclosure, but there are facilities where NBFCs are allowed to charge foreclosure or prepayment charges. Now again, the question comes, whether GST is applicable on this kind of charges. The main question which we need to answer it again, because the definition of service is very wide, saying that anything other than goods is service. So whether it will be a service, or again we can take a position that it is a breach of contract. If you again go back to Circular 178, which answer most of the questions in case of penalties, the relevant extracts which I have highlighted, I'll read out. It says some banks similarly charge prepayment penalty if the borrower wishes to repay the loan before the maturity of the loan period. Such amounts paid for prepayment of loan as contemplated by the contract as part of commercial terms agreed to by the parties constitutes consideration for the supply of facility, namely of acceptance of prepayment and of making arrangements for the intended supply. Therefore, such payments, even though may be referred as fine or penalty, are actual payments that amount to consideration for supply and subject to GST where the supply is taxable. Since these supplies are ancillary to principal supply, they shall be eligible to be assessed as principal supply. Naturally, such payments will not be taxable if the principal supply is exempt. Now, if we see the circular, it doesn't say this prepayment charges is a breach of contract. Now again, one can take a position still it's a breach of contract because the borrower has agreed that he will take this loan for a X number of period or X number of months or a number of years which has been agreed in the loan term. He is breaching that term and therefore we are charging him penalty. Obviously, when we cannot argue that interest is being computed considering that you will be taking the loan for X number of years. The interest is being charged based on the prevailing market rates. So that could also can go against the NBFC saying that you have already earned the interest till the date he has taken the loan from you. Now, but even though if we take a position that it is not towards the breach of contract, but it is a part of the service. The circular itself clarifies that the taxability will be decided based on the principal supply. Now under GST, whenever any ancillaries are collected, you have to decide, and which are naturally bundled, you have to decide the implications based on the principal supply. So the government itself has said that to decide the GST applicability on prepayment charges, you see the principal supply. Now in case of foreclosure charges, my principal supply is of lending activity for which I earn interest and which is not subject to GST. So technically, based on the circular itself, the foreclosure charges are not subject to GST. So there are 3 judgments which are being passed under the erstwhile service tax regime, which are relating to prepayment charges. We'll discuss those judgments. Now, in case of Commissioner of Service Tax versus Repco Home Finance Limited, the larger bench of Chennai Tribunal held that foreclosure charges are not a consideration for any taxable service. Instead, they are in the nature of compensation, especially compensation for the loss of future interest would have otherwise earned and the loan run its full course. So if you read this judgment, they have in detail analyzed the nature of these charges. There also they have highlighted or discussed that foreclosure charges are nothing but a compensation for a breach or the agreed terms of the contract. You cannot term it as a service. And therefore they held that service tax is not applicable on this contract or on these charges. The other thing which they had also highlighted is in case of any transaction to tax a service, there has to be a legal reciprocal relationship. Whereas in this case, there is no reciprocity. The borrower is paying the charges because of his voluntary act of closing the loan early, and there's no specific service which is being provided by the bank or the NBFC. And therefore, this should not be subject to service tax. Similarly, in case of Small Industries Development Bank of India versus CCE, it was held that the prepayment or foreclosure penalties are not consideration for the services, but are contractual penalties, and therefore not subject to service tax. Whereas in HUDCO versus Commissioner of Service Tax, it was held that prepayment and resetting fees are taxable under banking service category. Now, if there's a contradictory judgments, we need to also highlight that, or we need to also bear that the judgment in the case of Repco Home Finance Limited was delivered by a larger bench which has more authority compared to a single bench in HUDCO. Plus, they had also considered this judgment, and the other thing is, if we have to see that whether we can use these judgments in the current scenario too, it has a persuasive value because it does not, when the judgment is given, they have not relied only on the category, but they have also said that it is a penalty, not a consideration for a service. But what I understand is most of the NBFC and banks are paying GST on this foreclosure charges because of the notices being received by them, and in order to avoid any departmental liabilities, because later on they will have to bear this, currently they can immediately recover it from the borrowers. So most of the NBFC are paying GST on this transaction. The other issue which comes up is of the assignment of secured or unsecured debts, which is a common transaction in any NBFC or banks. Now again, when NBFC is assigning a debt or an unsecured debt, whether that could be considered as a supply under GST. So actionable claim has been defined because what is excluded from the definition, or what is included in the definition of goods is any movable property and actionable claim. And then actionable claim has been defined under GST Act to be referred to Transfer of Property Act. And Schedule 3 of the GST Act lists down the certain activities or transactions which says these are neither goods nor services, and one of the transactions is actionable claims other than specified actionable claims. Now, specified actionable claims are defined to mean any claim involved in by way of betting, casinos, gambling, horse racing, lottery, or online money gaming. Now, actionable claim as per the Transfer of Property Act means any debt other than secured by mortgage of immovable property or by hypothecation or pledge of movable property. So any debt which is a secured debt is excluded from the definition of actionable claim under the Transfer of Property Act. Now, there's a clarifications which were issued by CBIC at the initial rollout of GST, wherein the conclusion drawn has been set out in FAQ number 40 and FAQ number 41. So the question posed was whether assignment or sale of secured or unsecured debts is liable to GST. So obviously they explained the definition, or they have given the clarification of the definition of goods and said that sale or transfer or assignment or debts falls within the purview of actionable claim, the same will not be subject to GST. But any charges relating to such assignment would be subject to GST. Again, an FAQ number 41 has been set out, which says, would sale, purchase, acquisition, or assignment of a secured debt constitute a transaction in money? It says, sale, purchase, acquisition, or assignment of a secured debt does not constitute a transaction in money. It is in the nature of derivative and hence a security. So if you have gone through these FAQs, they clearly says that assignment of debt, whether it is secured or unsecured, is not subject to GST. But technically, if you read the reasoning which is given in CBIC, is not logical, in the sense they are saying that even the secured debt is actionable claim. But if we have gone through the definition of actionable claim as per the Transfer of Property Act, it says a debt other than a secured debt. So in case of secured debt, how do you say it's an actionable claim? Second thing, they are taking a position that secured debt is a derivative. Now, a debt is an obligation to pay a money. It's a money transaction. Whereas in the clarification, they are saying transaction it is not a transaction in money. And they are saying it's a derivative. Now, for a derivative, a product has to derive its value from its underlying. Whereas a receivable has its own value, inherent value, it does not derive its value from underlying. So technically, it is not a derivative. Anyways, the clarifications which have been issued by CBIC, they have concluded it's not taxable, but the reasoning which is given is not logical, because ideally it's receivable is the money and it's a transaction in money, because what happens when you are assigning a debt, a new lender comes into the shoes of the old lender and he just repays the amount. No, it's not a new transaction or new service which is being provided by the buyer. The other issue which is quite often being raised is on the sale of repossessed assets. So whenever a borrower defaults in clearing its loan, the assets or the properties which are being mortgaged are taken over by the NBFCs and they are being sold out. Now, what are the implications when these properties are sold by NBFCs? Now, the definition of supply is very wide. Even under the VAT laws, it has been held that the person who is actually undertaking the sale of the repossessed assets is the person liable to pay GST. So that we are not getting into that. But the main issue lies is on what amount you will pay GST. So if an NBFC is selling any movable asset, on what amount they should pay GST. Now for that, Rule 32 Sub-Rule 5 has been notified, which says that GST levy in case of repossessed goods will be only on the margin. Now again, that margin has been decided or has been defined to say it will be the sale price minus a deemed purchase price. Now the deemed purchase price, how it is computed as per the provision, the original purchase price by the defaulting unregistered borrower reduced by 5% point per quarter or part thereof between the purchase date and the original price, which means 20% depreciation every year you will claim from the purchase date till the disposal date to derive the margin and pay GST on that. Now, if you read this provision, it only says that the provision is for a sale of repossessed asset from a defaulting unregistered borrower. Now, what happens is, ideally, most of the big loans which the NPAs have given are to a large companies who are already registered under GST. It is not that only in case of retail lending this scenario could come up, which means that the rule which has been set out doesn't give a benefit to repossessed assets from a registered borrower. What it means is that when the asset of a registered borrower is sold by NBFC, they don't get this benefit and they will have to pay GST on the sale price. Now, ideally, if the registered borrower would have taken the credit at the time of purchase, there is no double taxation. But if the borrower was not eligible to claim any ITC on the asset which has been repossessed, it leads to double taxation on the same product. So obviously, there is a clarification which is required in this aspect, whether this benefit of deemed deduction is allowed even in case of assets which are repossessed by NBFCs from a registered borrowers.
URD has to be as on the date of purchase or sale?
Sorry?
URD status is to be as on the date of purchase of that asset or the sale?
According to me, it should be on the date of sale.
So it might be a RD when it was purchased. You would have taken.
You have to actually see on the purchase, because you will not have claimed, because why they are giving the benefit in the sense they are saying URD may you will not have claimed the credit. So therefore, to avoid that cascading effect, they are saying you take the deem, and therefore for registered borrowers, they are not giving this benefit because they are presuming that the registered borrower would have already claimed the ITC.
So URD should be as on date of purchase.
Purchase. That's my view. Now, the other issue which is also being raised by DGGI in NBFC, I think most of you would be aware of service charges in co-lending arrangement between NBFC and banks. Now, what happens is there are two models of co-lending which works in NBFC. One is where the banks and NBFC come together, disburse the loan in 80-20 ratio, which is the general ratio, to the borrower and take the responsibility for the respective loan. The other model is where the NBFC is the originator of the loan, and via back-to-back arrangement, they share the loan with the banks. Now, what happens is when in a co-lending arrangement is a specific blended interest rate is agreed to be given to a borrower, but internally it happens that the interest which the bank gets may be at a lower rate, and the interest which the NBFC gets is on a higher rate of interest. So what department is saying that the higher rate of interest which is earned by NBFC is nothing but a service fee, because they manage the entire loan, the entire loan management is done by the NBFC. So whatever excess is on is not towards interest, but towards a service fee which the NBFC is giving to a bank. And this differential excess interest which is earned by the NBFC is called as excess interest spread. Now the question comes whether it's a service fee or we can say it's an interest and not subject to GST. There's a judgment in income tax in case of State Bank of India versus Deputy Commissioner of Income Tax TDS, where this issue was relating to the applicability of TDS, and they had said that in case of co-lending, the extra income which is earned by the NBFC is not towards any service fee, but it is towards interest. So can we refer to this judgment to also draw the analogy which is by the court, saying that the extra amount which is earned by NBFC is nothing but an interest only. Now, there are a lot of representation which have been made to the council regarding this issue, and Finance Industry Development Council, in one of the representation, have entirely explained this co-lending situation. If one go through this representation, they have also clearly agreed that the higher interest which is earned by NBFC is not a service fee, but they earn because their borrowing cost is also higher. It is not that the service fee is being transferred to NBFC and therefore it should not be subject to GST. Now again in March 2025, an advisory has been issued by FIDC, which in a way has agreed that there could be a service component in the higher interest which is retained by NBFCs. So what they have said to the NBFC is that you decide, the co-lending partners should decide what is the service component. If any service component is involved in a co-lending arrangement, that should be clearly defined in your separate agreement or a master agreement, what is the service fee, and whatever service fee is being charged, that should be done with particular GST compliances which you have to do. And the valuation, again, I think the NBFCs had said that, or the other parties would have said that you decide a particular flat rate of service fee which should be agreed. But then again, FDI said that depends on various factors which each of the co-lending partners have to decide and agreed upon. So that has to be clearly defined between the bank and the NBFC in case of co-lending arrangement. Now, since this matter has been going on for a long time, we are expecting that this matter is going to be taken up in the upcoming GST Council meeting, and some clarification awaited on this issue. Now, moving on to the income tax credit issues which some of the NBFC have been experiencing. Now, we understand that GST is a value addition tax, that you pay GST only on the value addition. For the value addition, government has given the options or the process that whatever GST you have paid on your purchases, you claim as a set-off. If you are into an exempted business, obviously whatever GST you have paid will not be eligible for the set-off. So these provisions have been set out in Section 17 of the CGST Act. Now, there's a specific provision which is applied to NBFC, which gives an option to NBFC to opt for 50% ITC claim, which means whatever is the eligible credit in a month, you claim 50% and you lapse the balance 50%. So that's an option given to NBFC. Now, NBFC, once they have opted for this option, they have to follow this option for the entire financial year. There's one more, and when you are opting for 50% ITC, there's one more clarification, explanation given or proviso given to this provision saying that whatever there is a ITC available to the recipient pursuant to a cross charge between two distinct entities, that won't be subject to 50% reversal. So if there's a cross charge by one entity in Maharashtra to another entity in Bangalore, that ITC which will be taken by the Bangalore GSTN will not be subject to reversal pursuant to this provision. Now again, if we go to, this is an option which is given, but the general provision which has been set out is set out in Section 17 subsection 2, which says that whatever ITC which is attributable to exempt services has to be reversed by the taxpayer. So if NBFC is not opting for 50% ITC reversal, they have to go for this option where they have to reverse the ITC based on their exempt to total turnover. Now, when you go with this option of exempt to total turnover, again, there would be issues in computing your exempt income computation for each of your GSTIN. Your monthly reversals have to be done, and then true-up has to be done at the year end. You have to compute the attribution method. Second is, there's no explanation or a clarification given that if you opt for Section 17 subsection 2, whether the cross charge which is done between two GSTINs will be excluded for this reversal. So ideally, since there is no exception, even the cross charge will be subject to reversals. And obviously, according to me, there would be disputes in 17.2 if the cross charge is not at arm's length price. Whereas in the first option, even though there are the cross charge is at a lesser rate, department may not raise demand because Rule 28 of the valuation rule says if the recipient entity is entitled to full ITC, the invoice value should be accepted by the department. So in case of 50% option, the chances of dispute with respect to ITC on cross charge is lesser, whereas in the 17.2, if the computation of turnover or the ITC is not properly computed, the disputes are going to increase with the authorities. Now again, what happens is the NBFCs who are opting either for Section 17.2 or maybe 50% ITC reversal, where their actual exempt turnover is more than the 50% ratio. What I think most of you who are into this industry would have got a lot of notices in past few years where the department are using analytics to issue the demands. What they are doing is they consider your annual return as the base. They compute your exempt turnover as per your annual return divided by total turnover. They apply the entire percentage on your ITC, and they send the notice saying that 93% or 90% of your ITC is towards reversal and you have done a short reversal. So without getting into the an intimation or something, they directly issue a SCN saying that you should have reversed 93% whereas you have only reversed 50%. So while this is done as per the provisions, but unnecessarily NBFC have to respond and undertake the compliances which are not required, because ideally there is no provision in, if you see in the return or something, where you can declare that I am an NBFC and then I have opted for 50%. If this kind of provision would have been given, maybe you would have received a lesser notices, but practically looking at the challenges and the options which are being opted by the NBFC, this kind of notices are very frequent, and it is issued to every GST and every state, wherever your ratio of exempt turnover is higher than your total turnover. The second issue, which is relating to presentation of ITC in GST returns, which may not have been followed by some NBFCs because on the ground that it is not mandatory, but the way Circular 170 was issued, it was pursuant to 47th GST Council meeting, which says that you have to mandatorily report your ineligible ITC and whatever credit is available in 2B, even though you're not eligible to claim in that month, you show as a temporary reversal and you reclaim in the next month as a reclaim credit. Now, NBFCs who have followed this provision, what they would have done is, whatever ITC they have the invoices, they claim the credit. Whatever ITC they were not eligible, or maybe they were not aware whether it is eligible or not because of non-receipt of invoices, they reported those credit as temporary reversals in their GST returns. Now, once you report a particular credit in temporary reversal, what happens is does not get credited to your main electronic credit ledger. It gets credited to your electronic credit reverse and reclaim statements, which shows that this is a ITC which is there in 2B. Your temporary reverse it, which you are eligible to reclaim, as in when you account the transaction or when you receive the invoice, or any other conditions which you are required to satisfy. Now again, what is happening is, for the past period, currently I think the invoice management dashboard has been introduced, so some of the NBFC would have been using those things to accept the credits only which are required to be claimed. But for the past period where this process have been followed, you would have seen that you are getting notices from the department saying that this is the amount which is lying in your credit ledger, or maybe the electronic credit reverse and reclaim statement, you should immediately reverse it, without getting into the understanding that the supplier would be eligible to reclaim this credit because of non-payment to 180 days, where there is no time limit to claim the credit. So I don't know how many of you have got such kind of notices, but the department pushes that you reverse the credit immediately. They don't give you time, like till even October, where you are eligible to reclaim the credit. Thank you. Any questions?
GST applicable on commitment charges or AMC charges debit tax?
AMC, annual maintenance charges.
And commitment charges.
If the NBFC is regularly lending money on an intraday basis and the repayment is done at the end of the day, though the common parlance we consider it as an interest, does the department hold a contrary view? Because what we've seen is when banks lend on an intraday basis, they levy intraday charges instead of interest and subject it to GST.
But I need to check that, in the sense, does RBI regulate that this is the margin which you can keep? Is it based on the interest which is, or interest which is notified by the banks, or it is the banks or the NBFCs can decide on the margins?
No, margins are applicable in certain cases, but say the NBFC is lending on an unsecured manner, which it is very well within its right to lend.
But then you get the repayment immediately on the same
At the
day.
end of the day.
See, obviously we can take a position, but you have to prove that it's an interest which you are earning. Because you have to prove maybe the documentation. I don't know whether any documentation is being entered for these intraday loans or no documentation is being done.
It is.
Okay.
Is
See, the issue practically is that the way you account or rename a particular kind of revenue, the department will consider that revenue as that only. For example, if you're considering interest income as charges, department will say it is excluded from the definition of interest and therefore it is not subject to, it is subject to GST. Okay. So how do you account it? Do you account it as other
No,
income, interest
we
income?
name it as interest.
See, you name it an interest. Even in your contract, it says that it's an interest which is being, like this is the interest margin which the borrower is going to pay. In your, the documents which you are
Yeah.
entering. So I think a very well
And, the
case to
rate,
argue that.
and it is subject to a particular rate which is on an annual basis. Say,
So I think it's a good case to argue that it's an interest income, it is not a charges because you are actually transferring the funds to them to utilize for the entire day. It is not a processing fee or documentation fee which you are collecting from them. So even though banks may be calling it as intraday charges, one has to substantiate that what you are charging is for allowing them to use the funds for a day and not for providing any kind of service charge or service. Sorry, I can't hear you. See, one, obviously in this case, one will say it's an admin charge which we are charging because if you're changing the rate from say 12% to 9%, okay, the interest you are earning, which is on the lending activity, but why you are charging the admin charges? So the department say it's an activity which you are like you are doing for processing or maybe complying with the documentation which has to be done and therefore subject to GST.
Upfront interest deduction.
Sorry?
Upfront interest deduction.
Upfront interest reduction, I think we have already discussed. According to me, you have to substantiate with your documentation that whatever interest reduction is done, it is based on the interest rates or it is not a flat service fee which you are collecting and it should not be subject to GST. Merely you are collecting an interest upfront doesn't mean that it is charges. See, ideally, that's an issue which I think it's not about the NBFC. I think the entire industry is facing is how do you transfer the RCM credits from one state to another state? Okay. If you read Rule 39(1)(a) or of the CGST rule, which talks about that RCM credit has to be transferred based on the document which is issued under 54. Okay. Now, 54 only talks about the ISD credit distribution and the invoicing, and it talks about the distinct person credit distribution. Now, the question comes up whether you can only raise a like a regular invoice to transfer the credit or you will raise a e-invoice to transfer the credit. For your thing, e-invoicing is not applicable, but regularly if e-invoice is applicable, because if any other than NBFC is transferring the credit, they have taken a position that we will issue e-invoice because the law is not clear. Second thing is when you have to transfer the credit, how will you report in your GSTR1? There's no option to show a distribution of credit through GSTR1. The only thing is you're going to show it as an outward supply. Now, when you're showing as an outward supply, I would say that you will claim the entire 100% credit here because the entire distribution is going to happen from ISD. Take full ITC, show it as an outward supply. The 50% or whatever eligibility distribution is there should be done in respective state. Even though it's a cross charge, because then you can't take a benefit that it's a cross charge, I will not do the reversals. Because ideally it's only a distribution. Yeah, sure. Thank you.